Good afternoon, everyone. As we get started, I'm just going to give it a moment for people to come in. I'm seeing people pop into the session. For those of you that are here, as a reminder, if you, as we go along, have questions at all, there is a Q&A box that you can use on your bar that will send me a question. I'm going to have it open to my side, so I'll watch for that. And if there's anything I can answer along the way, great. If I can't answer it because it's too specific, we can always deal with it offline, but I will be happy to answer whatever I can. Sometimes taxes get too specific, so we'll see. Um, from that, though, as long as we have people on here that are ready to go, I think I will keep moving. So thank you for joining. As we get started, today we're going to be talking about taxes. If you are going to join us next month at all, next month I'm going to get into tax planning 201. Today's 101. It's a little more of the kind of blocking and tackling behind tax planning for investments and retirement. Next month, I'm going to get into some more complex strategy around tax issues around investing. So feel free to join us yet again. With that, I'm going to get started. And as we go forward, I'm going to remind you, because our lawyers can't attend these sessions and share with us, that you should look at all this information as fairly general and not specific to your situation. So please seek out professional guidance. If there's anything we can do to help in that, let us know, for we are a comprehensive firm. Again, my name is Jon Meyer, for you that don't know me, and I head up the wealth management side. Today, as we get started, um, I'm going to run through a whole bunch of really fun stuff, and it's going to get a little bit into where things are at with some current information, but I'm going to get into a bit of a strategy too. So as we keep going, I'll try to slow down a little bit on some of that. Some of the current stuff really, there's some that's kind of current and some that's kind of like an extension of what was going on if you've ever heard me talk in the past. So just keep that in mind when I talk about updates. Some of this may sound familiar, and that's okay. So as I get started here, let's talk about where things are at from what I'm calling updates, but really some of this changed in the last year or so. Um, Basically, we have a couple of things that this group needs to hear. And when I say this, by the way, too, a lot of the updates I'm going to share with you today are not inclusive of every update out there. So if you go look up, for example, the one big beautiful bill, you're going to find all kinds of information in there. I'm not going to spend a lot of time today talking about some of that. For example, Trump accounts, which come online in the summer. Today, I'm not focusing on that, but those are the kinds of, there are other things out there. So just know that I'm trying to focus on the things that I think apply to a group of people interested in tax planning as they move on in life. So today, what I want to focus on is the RMDs as the first thing, required minimum distribution. If you remember, back in a couple years, they switched things, and I just bring this up because we run into this question a lot, and we run into a lot of confusion by people. But basically, for most people now, starting in 2023, the required minimum distribution age changed. It used to be 70 and a half. Now it's age 73. And then starting in about now 8 years or 7 years from now, it'll actually increase to 75. There is a progressive scale there, so it goes up by month. It's not just going to go from 73 to 75. It'll go by, a few months at a time. But just keep that in mind as you start thinking about it, because it sounds like a good deal, but the other side to it, and I'm going to point this out as we go along, is what it's really doing is it's making even more compact the number of years you have to empty an IRA or a 401k, based on life expectancy. And the more compact you make that scenario, sometimes the higher your tax rates become. So those are the issues that I'm going to bring up as we go along. The other thing that I want to note is that there is a new reduction in penalties that came out at that time too, that basically said if you make mistakes, we're going to lower the cost to that mistake. It used to be literally a 50% of the what should have happened would be taxed. So if you missed an RMD or something, you'd have a 50% tax on that. That's been lowered, and really, as long as you have a good reason, it's down to 10%. So I bring that up also because we do run into scenarios where people make those errors. Second thing that's interesting is no RMDs now on Roth 401k and 403b plans. That started about a year and a half ago. I've seen confusion around that, but that is the current answer. There's always been no RMD on Roth IRAs. People were asking the question about 401ks, so they actually clarified that. Third thing is that the catch-up contributions for 401k and 403b plans in 2026 are slightly higher. So at age 50, they are now $8,000. This is different than the IRA catch-up contribution. That's a different slide. So just hang on that. But basically for 401k or 403bs, it's now 8,000 for a catch-up. And if you remember last year, they added this new 60 to 63-year-old catch-up, which means in this age group, you can actually do more. So it's your standard contribution plus this catch. And then finally, as a interesting topic, 529 plans have shifted a bit, and now there's a new rule that basically says if you want, you can take up to $35,000 out of a 529 to fund a Roth IRA for a child. Now there's rules around that. Whoops, I bumped something. There's rules around that. And the rules are definitely sometimes onerous. For example, the Roth has to have been in place for 15 years. You can't take it out all at once. It can't be 35. It can only be to fund the Roth contribution limit for that year. The child still, of course, has to have some income. Like there's rules that fall into place here. So before you just run out and do it, make sure you talk to a professional to make sure it actually fits. Now let's get into a little bit more of the strategy discussion. I am going to talk about, as I get into this, a little bit of an update too on deductions with the one big beautiful bill, but that's coming in a few slides. Let's talk first about some just broad strategy discussion, because what you need to understand for the rest of today is how to think about taxes based on brackets of income. So if you think about it, just as an example here, your investment return basically is the actual gross return minus fees and taxes. Makes sense, but what does that mean? In this scenario, what I'm simply saying is if I had $1 million account earning 7% rate of return, what is the difference between me paying a 12% tax rate and a 22% tax rate? At first glance, people would say 10% difference. But the reality is your actual taxes are 83% higher, to the tune of 7,000 for the year. So it's just an example of how to think about the underlying math. And I bring it up because as we talk about maximizing tax brackets, sometimes people say, oh, I just need to jump a few, or I can avoid this by a few percentage points or whatever. And it's sometimes the math isn't that simple. So I'm going to back into this in a different way. Let's start with where brackets are at today. So in 2026, this is the current brackets. And the way to read this chart, by the way, this chart is the chart that we memorize almost. I would encourage you to use this kind of a chart at all times in your daily life when you're thinking about this. Throughout this presentation, this is a chart I'll kind of refer to. But basically, the way we want to look at this, I'm going to today talk mostly about just joint income. So if you're on this call and you're single, basically whatever I say for joint income, just cut in half. But when I look at this, the way our income brackets work is the first $24,000 of income, if you look at it, you don't pay a lot of tax on this kind of stuff. So it's really the first 100,000 we worry about, because at the first $100,000, you have this 12% tax rate. And the biggest shift is from 12 to 22. After $100,000 of income, you go up to anywhere from there to 211. You now jump up into this new bracket. So That's where we want to focus is how do we look at brackets? And as I talked today, one of the things we want to focus in on is if you're inside of a bracket somewhere, let's say your income were 110,000, the next dollar you earn is at this 22% bracket, not moving you up and you're not going back down. You're at 22. So if you look at your life and you think, as I start taking minimum distributions or add Social Security income or whatever else is going on in your life, if that's going to push you into a higher bracket, your best scenario is to look at the bracket you're in and maximize it. And so, in essence, what I'm saying is it pays dividends to pay more tax sometimes in your current year, as long as you perceive that bracket to be lower than what your future brackets will be. In that scenario, let's say we had 110 and I can go all the way up to 210 basically in this bracket. I had $100,000 of wiggle room that I could pull out of an IRA, a 401k, however you want to think about it, as taxable income, but it might be worth it. I think this is the biggest shift in thinking for a lot of people as they get into their retirement years. As we go up these brackets, the other thing to note is we start to have some Medicare surcharges, and these things can start to come into play as the bracket numbers hit certain levels. So when we start thinking about tax rates, it's not just the tax rate you're at, it's we got to look at these extra surcharges and think about what tax rates do you actually fall into. So that's looking at just federal. If we look at the capital gains rates, they're a little bit different because that first 100,000 almost basically is at zero. And then after that, we jump to the 15. So this is a key point. And I'm going to go backwards if I could. Basically, in this bracket, you don't pay any capital gains tax. And so if you can fall in that bracket, it may behoove you in those years to actually create some capital gains at the 0%. Just a note. When we look at this from the standpoint, though, of what most people land, and most people are going to land above these numbers, and so they're probably going to be in this 15% bracket. They will potentially fall into this Medicare surcharge, and so they actually end up paying a little bit more. Okay. Now, the Medicare surcharge, by the way, is when we go over jointly $250,000. So it's not on this full 98 part. It's kind of in the middle of that, but it does start to pick up in here. And then anything over that, we jump yet one more bracket up. So when people talk about what's the capital gains rates, these move a little bit too. And this is just federal. So now let's throw in state. There are plenty of people on this call in states outside of Minnesota, maybe, but for now, I'm going to talk about Minnesota. Other states are going to be similar, maybe, except for if you live in Florida or somewhere where there is no state tax. But when you look at it the way Minnesota does it, they also graduate rates up as you go up in income, with our highest rate being 9.85. There's only a couple states at these levels. California is slightly higher than that, but we're probably in the higher end of this. A lot of people, if your income is below 300,000, is probably going to fall into the 7.85 number. But this is important because for Minnesota, this is your income tax rate, but this is also your capital gains rate. And so when we talk about capital gains treatment, we'll say federally you might be 15% or 20%, but then you add on Minnesota rates on top of it, and you can quickly get closer to 30%. So that's why we, when we're doing loose calculations with clients, especially, it's like just assume you're going to pay probably 30% in tax on capital gains. All right. Let's jump into a few other tax considerations before we get going on some ideas. Federally, there is a $15 million estate and gift tax that started in 2026. Last year, it was 13.99 million. It's now elevated to the 15. And basically, when I say estate gift tax, what that means is you can use this either when you pass away, but you can also use it while you're living. The issue is if you use it while you're living, file a gift tax return that says, I want to use this gift tax early, and then in essence, no tax due, like you can, because you can use it early, this exemption. So no tax due because you filed a gift tax return saying just wipe it clean, but you're using it early. So when you die, you don't get 15 anymore. It's 15 minus whatever you already used then. That is not true for the um, annual exclusion, which is 19,000 a person. I think that's on a different slide actually, but that 19,000 doesn't count towards this. So when you look at it from that standpoint, that's an interesting thing to consider because here in Minnesota, there is no gift tax. So in Minnesota, that this 15 million doesn't apply. In Minnesota, you can give as much away as you want um, to anybody as long as you live 3 years, and it won't be includable in your estate. So we do have these conversations often with people about when they should be gifting, whether at death or while alive, and um, but there is this exemption. The second part to that exemption is it is portable at the estate tax level, meaning federal level. It is not portable at the state of Minnesota level. So what that means is 15 million. If you're a married couple, that's 30 million. Portability means if one of the couple doesn't use theirs, the other one can port it over and use it themselves. So as long as you do your estate planning well, most couples have 30 million to play with. In Minnesota, that's not true. In Minnesota, there's no portability rule. I'll get to the Minnesota numbers in a second, but in essence, in Minnesota, it's kind of a use it or lose it rule. So you got to be careful. If you go over the limits of 15 million, it's 40% tax rates, just so you know. And then we have things like standard deduction. And here's where I wanted to get into some other issues because we now have some new rules around deductions. The OBBA, the one big beautiful, it's not OBBA, I should be OBBB, one big beautiful bill, added some things, and I'm not listing all the things it added, but for this group, I think what you need to know is there is a new $6,000 enhanced senior deduction if you're over age 65 for the next few years. You will see that on your 2025 tax return this year, since that's the season we're all in. So just a heads up, that's kind of a cool little extra deduction. Secondly, there's a new SALT deduction, and this is basically if you itemize, if you remember, up until 2025, there was a $10,000 limit on state and local real estate taxes on your tax return. So if you itemize, doesn't matter what your Minnesota tax would be and what your real estate tax would be, it would just cap it at 10,000. For the next few years, that cap is increased to 40,000. So there is some ability maybe for some people. It does have some scale backs for income. So if you have income above certain limits, you lose it. That is in there. I'm not going to get into it. And there's also a cost of living adjustment that could add some potential benefit. The bigger one that I am not seeing a lot of people talk about is the new caps on charitable giving. And so I wanted to throw that in here. There's new caps on charity that basically say, and it's on both ends of the spectrum, there's a new 0.5% floor. So what happens is you look at your adjusted gross income, and the first 0.5% is not deductible for charitable purposes. So think about that. It may not be a lot of money. Let's say your adjusted gross income is $100,000. 1/2 of 1% of 100,000 is $500. But that means the first $500 you give to charity is not deductible. So that floor is an interesting new twist. And what I will say is, and this is what I really don't like about it, once they put floors like this in and stuff, it's easy for them over the years to, pass legislation to just increase them a little bit, and it kind of whittles away. So I'm not quite sure where we're headed on charity, but that is a floor issue. On the top side, there's this new 237th rule. And in essence, what they're doing is they're saying that anyone above a 35% tax bracket you need to now divide everything by 2/37 because anything above 35%, we're basically going to restrict you to taking the tax deduction only at the 35% bracket. So for people in super high brackets and you want to give to charity, you're restricted to only a 35% deduction. And you might say, well, that's just 2%. That's not that big a deal. But if you look at the math, you actually have to do the 2/37 division, not just subtract 2%. And so really what some people will say is, so if I wanted to give, um, $100,000 to something, it might shave off whatever. It might actually shave off, instead of a couple $1,000s, it might shave off $10,000. So you got to go through the math to figure out if this is going to affect you fairly negatively this year. It did not apply to 2025. So anything you're doing on this year's tax return for last year, you're good with. But starting in 2026, this is a new rule. So as we do charitable giving, I would encourage people to reach out and talk to their advisors about what this actually means. And if someone says, "Oh, it's just 2%," they're wrong. You gotta do the math behind it. A couple other changes. I mentioned the state and local real estate tax limit already, so that's in there. The mortgage interest deduction did not move. That actually got codified at 750, so that's still there. We do have some other minor things in here that I've mentioned in the past. Nothing exciting, but I do want to at least point that stuff out. And here in Minnesota, as I've already mentioned, we don't have a gift tax. So if you want to give your kids millions and millions and millions of dollars, you can do that. You just got to live 3 years. As long as you do that, you're good. And then you can also give the 19,000 per person or 38,000, married to any person individually. So if you do have multiple children or grandchildren, you can give a lot of money away if you want and not even worry about filing gift tax returns. Here in Minnesota, also as an aside, I mentioned this already, while the federal limits are 15 million, here in Minnesota, it's 3 million. So we don't have a portability rule and I mentioned that this 3 million per person means you have to use it. And how do you use it? Well, let's say you own a bunch of assets, and because of the way things fall, one person in the relationship maybe worked more than the other, so their 401k is bigger. You can't move a 401k to someone else's name, so that means their name, they have more assets. So you have to look at things and equalize it as best you can, and that's where we end up moving, homes and accounts and stuff to different name, each person's name, to try to equalize it. So in an ideal scenario, in a $6 million estate, each person would have exactly 3 million on their side of the fence. If you can't do that, then the problems start to occur. So I just bring that up because Minnesota, you do have to make sure that equalization, which really means retitling things, is done before someone passes away. Whereas at the federal level, you have the portability rule, so you can do that. You can use it. All right. I know I'm moving fast, but I want to keep this flying a little bit. Let's talk about some tax planning opportunities. This is a slide that basically just lays out a whole bunch of really fun things. If you look at it, and I mentioned this already, capital gains and the 12% income rate are at 0. So if you can use that, focus in on it. And that will not happen for everyone every year, but there are times where we see someone just slips down there in a year. So good tax planning in November, December timeframe will matter. Secondly, maximize your contributions on investment accounts. These are the different things. What I would focus in on is definitely maximizing for retirement purposes, of course, but maximizing from the perspective of tax flexibility, focus on Roths and focus on HSAs. If you really want an interesting insight into HSAs, you can go on our website. My most recent podcast dropped yesterday where I interviewed somebody who was there. You can go look. He was there at the beginning of the HSA movement and helped pass the law. So it's fairly interesting about these accounts. All right, third thing, and I mentioned this up front, it really should not be just a point to minimize taxes in retirement. It should be a point to maximize tax brackets. So we go from the word minimize to maximize because distribution strategy is different than accumulation strategy. And if we don't look at how do we maximize brackets in certain years when we can control things, what ends up happening down the road is we lose control. And we lose control specifically oftentimes after age 70, because that's when you have to start taking Social Security. And secondly, RMDs start in your early 70s. And so all of a sudden, we start to lose some of that tax control. Uh, Low income years is an interesting one. Strategize available opportunities in low income years. I throw this in because we see so many opportunities that are lost when people have low income years. Sometimes they didn't plan on it. If you think about COVID, there's some there were some companies where people, small business owners, had negative income for the year. And in those years, let's say you had negative income. Um, if you had an IRA, you could have potentially done a Roth IRA conversion and with negative income, maybe paid zero tax. So it's opportunities that are lost because people aren't just having an ongoing conversation with their advisors about what this means. So I bring that up as an example that I have seen happen. If you have stock options, exercising them in a coordinated manner is an issue because there are ways to hopefully income smooth a little bit. Gift income generating or highly appreciated assets. Um, if you have, here's what shifted over the last, well, it's definitely shifted over the last 20 years. Coming out of 2008, when interest rates dropped to zero, basically we gave up on this idea of an income generating portfolio. Just wasn't available. Now, after 2022, as interest rates went back up, it's available, but we've basically shifted to more of a let's create a portfolio that has a total return capability. Now we're coming back to, okay, what about some income generating ideas? The problem with that is some people are so focused on income generating that they're actually pushing their tax bills higher than they need to be. And so we're actually having conversations more and more about giving away, if you're going to give assets to your kids or your grandkids, giving away assets now that are actually generating a lot of income because it would also help on the tax return. And could be highly appreciated, but I'm just saying that's another way to think about it. I will say whether it's income generating or highly appreciated, I would say those are still better answers oftentimes than gifting cash. More likely than not, your kids and your grandkids pay lower tax rates than you, but who knows? And then finally, tax exempt or muni bonds. So we have examples of some of this stuff. So let's get going. In investing, one thing to consider when you think about tax planning, and it's too late now for 2025 because we're talking about this in 2026, but at the end of this year, you want to think about this. Let's pretend we have two different funds that you're invested in. In one case, it kicks out 48 cents a share long-term capital gain, 21 cents a share short-term capital gain. In the second case, flip those numbers. So instead of 21 in the short, it goes 21 cents in the long, and that 48-cent long goes down to 48 cents short. If you think about that, in both cases, you have the same amount of income. It's just how was it categorized, right? Long-term gain or short-term gain. As a step back for a second, long-term gain is anytime you've held something for more than 12 months. Short-term gain is anytime you've held something for less than 12 months. That's how that's categorized. So if your income's the same, here's the question, what's the tax due? Well, in this case, since more income was long-term, your tax bill's lower than over here where more income was short-term. The short-term means that it's going to get taxed at your current income tax rate, not capital gain rate. And your current income tax rate probably is higher. So in this case, we're assuming, if you look at my notes down here, we're assuming 22% capital gains rates versus 43% income tax rate. This does averages. So in that scenario, here's what you got to look at. What if we sold the fund to avoid these issues? Well, if our cost basis is 95,000 on a $100,000 fund now, that's $5,000 worth of gain. And at these tax rates, if I sold the fund, I'd have to pay $1,100 in capital gains tax. In this scenario, my fund A, I can either pay $1,100 by selling, or I can pay $866 by keeping. So it makes sense for me to keep the fund. But in this scenario, by selling, I pay less tax than if I kept the fund. This is an analysis that needs to be done on all investments every year at the end of the year, because you need to really understand, should you keep a fund before it pays out its dividends, or should you get rid of it? Too many people don't do this analysis, and then they wonder why their tax bills are too high. So this is one big tax planning opportunity. Just bring it up. Second, the difference between Roth and traditional IRAs. I'm not going to get into every detail here, but where we see the biggest bang for the buck when it comes to these discussions, most people come to the table with IRAs, IRA/401k. In the scenario of Roths, however, the Roth allows us to put money in after tax, whereas the IRA is pre-tax. But the Roth then allows us to grow it without taxes, and when we pull it out, it's tax-free. So when you think about it, it goes to a bigger strategy. Most people get to retirement and they have a pile of money. And let's pretend the pile of money, well, I don't even have to put a dollar amount on it. Typically, that pile of money, in my best judgment, should be about 50% of your wealth in IRA 401k world, and then 50% in other world. And other world could be Roth, could be HSAs, could be a brokerage account, could be cash in your bank account. This other world is taxed less, whereas the IRA and 401k world is taxed more, because that world, you're pulling it out and you pay income taxes when you pull it out. The other world has anything from tax-free, like Roths, and quite honestly, HSAs, if you use it for appropriate medical care, or brokerage accounts, which get capital gains rates. So when I look at this world, what I typically see is not that. I never see a 50-50 split. What I typically see is something more like 80 to 100% of people's money in IRA and 401k world. And when you have that much money in that world, you lack a lot of tax control in the distribution phase. And so we try to figure out oftentimes, how do we get money out of the IRA 401k world over into the other worlds? And that's where that maximizing a tax bracket makes sense. Because at the end of the day, if we can, what we want to think about is, do we have the ability to do Roth conversions, for example? And Roth conversions are pretty interesting. We can basically take money out of an IRA and move it to a Roth. And that can be done in an IRA or in a 401k now. By the way, if you're a business owner, you do need to amend your 401k to allow this. But in this scenario, what we do is we'll pull money out in a certain tax bracket that we want out of the IRA, move it to a Roth, and now it grows tax-free. Now I have to pay the tax on that. But if I do time value of money, assuming in the future I'll be in a higher tax bracket, that might make sense. The second opportunity with Roth conversions really is this backdoor Roth. For people that don't have IRAs, you can contribute money to an IRA, or let's say you can't qualify for an IRA because of your tax bill or your income limits being too high. You can contribute to a non-deductible IRA, and since it's non-deductible, you're not getting a tax deduction. But then convert it to a Roth, and since you already didn't get a tax deduction, this isn't a income issue because you're not going to pay tax on something that you already paid tax on. So just convert it to a Roth and now it's in an account that's going to grow tax free forever. Similar concept, by the way, is this mega backdoor Roth. I'm not going to get into great detail, but in essence, you do what I just said, except you do it inside of a 401k where you can do much bigger contributions. And so there are people, especially business owners, who could potentially do some really big conversions because they're making, 40, 50, $60,000 contributions to their 401k. So those are your opportunities when I think about where IRA and Roth conversions are. People sometimes will ask me, well, where does Roth conversion make the most sense? So came up with this chart years ago to explain this concept. And in essence, really what we want to think about is what stage of life are you in? Because here's where Roth conversions probably make the most sense. Anytime you see this bar not going above this 12, Roth conversions may make a lot of sense. And so depending on stage of life, early on in retirement, you can see oftentimes we want to do Roth conversions because we may down the road, especially after age 70, be locking in on higher rates. The other thing to consider in this could be years where you have blips. We call it a business startup scenario, but it could just be that your business struggles for a year or two. There could be reasons in the middle of all this where Roth conversions make sense. For the most part, when our incomes are high and our tax rates are high, we usually don't do Roth conversions. And so we have a couple stages here that we just kind of call out as, you're advancing in your career or you're really developing high income. The caveat to that, if there is a caveat, is if you are even in a high bracket and the market's corrected a lot, let's say the market's dropped 30, 40%. We've seen it in the past, right? You might consider paying a higher rate on a conversion, knowing that this blip in the markets will correct itself over the next couple of years. And so you're converting at a lower number that if it bounces back, because you're bouncing back on assets that you think will grow, you could overall average your tax effect down. So just an aside, you don't see it done a lot because again, people have to pay the tax, but that is an opportunity. On the back end, just so you know, the reason people like this too is your heirs. When we get to the heir part of things, if they inherit IRAs, they have IRA or 401k, they have to pull it out over 10 years of their life expectancy, or once you die, they have to pull it out over 10 years and be done by the 10-year mark. So in essence, you're going to kind of force them to pay higher taxes probably. Whereas Roths, you still have the 10-year rule. But since Roths are tax-free, they don't pay any tax when they pull it out. Now let's talk about RMDs because this gets into a timing issue. In essence, and here's the trick. Instead of getting caught up in this calc, think of it as Roths are basic, or Roths, RMDs, required minimum distributions, which begin at age 70 for most now, are going to be basically 3.5% of your account value as of December 31st of the previous year. So if your IRA after age 73 it had $1 million in it, instead of doing this 26.5 thing, just look at it as 3.5% of 1 million, roughly. It's not quite the same because 26.5 is 37,000, whereas 3.5% gets you to 35,000, but it is close. So if you think of it that way, you can kind of guesstimate where your income will land for every $1 million of IRA money you have. Now, I will point out that's not how you do the math. So make sure you use the right expectancy tables. Depending on the way you do it, your brokerage firm might have a calculator online to do it easy, but I'll just point that out. Let's talk about it from the standpoint of managing it though. What we see too often is this example. People need money. I had this happen quite a few times actually in December. People need money and they say, send me this money. I got this project, or send me this money for some spending issues. Um, Here's what happens. They need $140,000 IRA distribution. We look at the tax rates and we're like, okay, based on the first 24,000 of that is going to be taxed at 2,400 bucks. The next 75 grand is taxed $9,000. And then the rest is taxed $8,000 because of this climbing scale. And so total tax expense is $20,000. Now, if I just ask one more question, half the time it's, well, when do you need the money? Because at the end of the day, most people don't need the money immediately. So let's do this math differently. What if I said, oh, you don't need it all in December. Let's do half of it now and half of it January 2nd. So now I'm looking across two different tax years. And what ends up happening is I never trip out the higher bracket. So what ends up happening is I save the client almost $4,400 in taxes by just asking that question. And I bring it up because we oftentimes do see people who are pulling money out at what I would consider inopportune moments because of the way that tax system works. So this is one example to just focus on how am I timing things. Now let's talk about that fun 3.8% Medicare tax. This one's no fun, but I want to point something out around it because people just assume it applies no matter what, and it doesn't. It's basically been in the law for a long time and people still don't know how to use it. It's based off of modified adjusted gross income thresholds. The negative to this is these thresholds haven't changed since 2013. So if you think about time value of money or inflation, this tax is actually getting a little more onerous on us as all our incomes probably are going up. But in essence, what's happening is it's this 3.8 is being charged if we go over certain limits. However, only if we go over certain limits in certain ways. And here's what that means. The 3.8% Medicare surtax is only based off of investment income, okay, which is interest, dividends, capital gains, annuity, and rental income. It's not based off of wages, pensions, unibond interest. So when we look at some of this stuff, and by the way, IRA withdrawals either are not included in that. When we look at that, that does dictate sometimes how we want to pull money out of a portfolio. This is where distribution strategy gets complex. I'm going to show you an example, actually two examples. Actually, four examples, two examples per slide. In this example, we have scenarios where that 3.8% is not getting tripped. And the reason is if you look at it, the first case, Fred, who's single, has salary income and then some investment income. So he hits 150, but because it's less than the 200 that he gets as an individual, he doesn't pay the 3.8. Secondly, Tony and Tina. Yes, I pulled this from Tony and Tina's wedding. Tony and Tina have 300,000 of salary. They have $50,000 of IRA withdrawals, so that's considered standard income, not capital gains, interest, or dividends. They did $50,000 in Roth conversions. Again, that's considered standard income. And they have no other investment income. So the 3.8% does not hit them, even though they've gone way over the threshold, because they're not really showing investment income. Here's where investment income shows up. Scott and Sarah have a salary, but now they also have investment income of a decent amount. And now they're over the threshold. But the 3.8% applies to them above the threshold. So really it's 350. They only pay it on 100 because it's the excess over 250. So 250 to 350 is 100 grand, they would pay that 3.8 on. And then I threw in a surprise because the surprise always catches people. There are trusts out there and trust income rates are much lower. So in this scenario, the trust has $50,000 of investment income, the 3.8% does apply because in a trust, the first after 15,650, you're now hitting the threshold. I bring this up here, but I'm going to bring it up and if I talk to you about income tax rules too. Trusts have much, much, much lower limits on tax issues. And so trusts oftentimes are not great vehicles to accumulate a lot of income. Oftentimes you want to get income out of a trust and into the individual taxpayer so that the individual can pay at a lower rate. So just a heads up, doesn't mean you can't fix this. It's just that is an issue. As I come to the end, if you do have questions, I want you to make sure you bring them up because we're getting closer to the end. Just want to give you an update on where bond rates are at today. So if you were to change between what we all think is good rates in the municipal bonds, here's what's going on. Current rates, and this is as of February 20th, so 5 days ago. Current rates on a CD were about 3.95% on a 5-year CD. And when we looked at muni rates, they were 2.67. But if you translate taxes, and here's the calculation, you can test my math. Basically, if you go backwards on taxes, that means that the CD on an after-tax basis is paying you 1.95. Whereas the municipal bond, because now you reverse the math, 2.67, which is tax-free, really is like earning 5.4. So if you have been with me over the past many years, I've used this calculation before in slides. This math is now reversed. 5-6 years ago, CDs and stuff actually were looking better, probably. So just a heads up. All right. Couple of quick tips. Always give away appreciated stock, not cash, if at all possible. Basically, we look at it this way. If I had to sell a stock where I had $7,500 of capital gain, basically I end up after paying taxes, after a stock sale, I'd have $8,200 left to give to charity. Okay. If I have AMT issues, it's even worse. But if I give away the whole 10,000 without selling, now I get to write off the full 10,000. Again, I see people making that error, so I bring it up. Secondly, in charity, use donor advice funds if you can, because you get to take the tax deduction today, but then you can give the money away tomorrow. And when I say tomorrow, it could be over the next decade for all I care. The strategy here is to always use highly appreciated stock, if possible, to gift to the donor advice fund. The donor advice fund will then sell the stock, and now you have the cash. You can either keep it in cash or you can reinvest it in some investments inside the donor advice fund to keep growing it. You don't realize the gain because the charity sold it, so it's not your problem. But you get a full market deduction for the money you gifted. So it's a really cool way to do things. And what we typically do is pair this up with other strategies. We might do a Roth conversion paired up with a donor advice fund contribution to offset the tax hits. Or we might look at certain years where we know you have other things coming, like a sale of a company or sale of real estate, and pair up with donor advice funds. And what I'll often tell people, because people are like, well, I only want to put a few thousand into it. I often tell people, let's look at 5 years worth of giving and donate at least 5 years to the donor advice fund. Because again, we have to get over the itemized income thresholds and all that to make this donation tax deductible. So we want to put enough in that it matters. That's a whole different issue, but I bring it up. All right. Just so you have an update on Social Security, basically, Social Security has not changed much. If you earn income below these rates, you do have the ability to pay less tax, but most people on this call will not be below these rates, and so you're probably paying the highest tax. And as I get towards the end, the one that aggravates everyone is the IRMA rules. IRMA is a fickle lady when it comes to Medicare premiums, because what ends up happening is if you go above certain income limits, and here's, let's look at joint, anything above 218, you basically below that pay this rate. But if you go above it, now you pay that rate plus an extra dollar amount. And so you end up with these extra rates where you pay the Part D, which is your drug costs, have an extra hit, but then your Part B, which is your other costs, your doctor costs, that goes up as well. And so what ends up happening, if you look at the annual difference for individuals or joint, I don't care how you want to look at this, you're paying more money by having these IRMA calculations kick in. This aggravates a lot of people. And what I'll tell you is when these things are looked at, the IRS basically is pulling your tax return from 2 years ago, because that's what it has most recently in its vision. And so if 2 years ago you had a high income year for whatever reason, let's say you sold a company or exercised some stock options on your way out to retire or whatever, as long as it's kind of that one-time event, you can actually file a request with Medicare to reduce this problem back to normal, so this lower level probably, but you only get a one-time exemption. So please, if you do it, use it wisely. So it's on the one time you might need it. But this is something you got to take into account. So when we talk about income rates, capital gains rates, we then bring in this Medicare ID and say, and then what are IRMA rates going to do? Because all these things basically increase your taxes. The last two things, I'm not going to get into deep detail, but for those of you that are business owners, Minnesota PTE has been extinguished as of December 31st of 2025. Basically, for you out there who are business owners, you can pay your Minnesota tax and have it deductible for federal purposes. This is currently in front of the legislature, and if they go ahead with that bill, they would pass an extension for, I think, 2 years. So we're just watching that. Hopefully it does pass, but that's a big deal for some people. And then the other big deal for some people is this QBI deduction. I'm not going to get into this. I look at who's on this call, and I don't think this applies to too many people. So if you want to get into QBI, I'll let you connect with us and we can talk about it. But it does basically allow you to deduct a chunk of your income that you don't have to have taxed. But there's certain rules around it. I put in some of these rules, but in general, I want to move on from this. So with that, I'm going to bring us to the end and take questions. First questions. Okay. So the first question is, at what age can you start taking out 401k money without a penalty? And does that apply to a Roth 401k? So the rules on 401k are interesting. For IRAs, you have to wait till age 59 and a half to pull money out of an IRA, unless you do what's called separate and equal periodic payments. What that means is in an IRA, you have to, if you choose to pull it out before 59 and a half, you have to take it out over a minimum of 5 years. So let's say you were 56. If you started pulling something out, you had to pull out that same amount for 5 years, even though 59 and a half, technically the rules change and you can now do whatever you want. The answer is no. You got to stick with the original 5-year rule. So from 56 through 71, or I'm sorry, through 61, you would have to pull out that same amount. So if you get into that separate and equal periodic payment issue, it's a whole different strategy. The difference between IRA rules and 401k rules is 401k, as long as you retire from somewhere at 55, you can actually pull money out of the 401k without penalty starting at age 55, and you don't have those separate and equal periodic payment rules. So it's a different rule, but it's something that has to be looked at because so many people by rule will just simply, you know, retire and move their 401k to an IRA. And as soon as you do that, you lose that opportunity. So keep that in mind. 401k rules can be used slightly looser, but you have to, if you leave at age 55, then you can use them. But you have to leave the money in the 401k. Another question. Um, Repeat the caveats for gifting unlimited amounts, not subject to Minnesota estate tax. Okay. So the rules for Minnesota estate tax are if you die, you can give away up to $3 million. And after that, you're subject to estate tax. But Minnesota has no gift tax rules. So if you give it while living, that 3 million doesn't apply. While living, you can give someone as much as you want and it doesn't apply as long as you live at least 3 years past the gift. So this does come into play. We will have people who they'll get later in life, they get sick and they're like, I'm going to start gifting money, and then they die too soon. It could get pulled back into their estate. So I encourage gifting whenever you start feeling comfortable about it, as opposed to waiting until the end. But that's the rule. Now, if you gift anything above 19,000, Minnesota rules be damned. You do have to still file a federal gift tax return that says, I want to use up my lifetime exclusion at the federal level. So Minnesota lets you do it a certain way. You still have to follow all the rules, though, for how federal wants it. So just a heads up. All right. I don't see any other questions, just some thank yous. So I appreciate everyone attending. If you have other questions after the fact, please reach out. I will also point out, just because we're in the new, we only started this in the last month and a half or so, but we have started a podcast. And if you want, you can find it on Spotify, Apple, and probably many other places. It's on YouTube on our channel. And if you want to go on our website, you can find it under News and Insights and find the podcast there. So there's all kinds of ones, like I mentioned, the HSA one's the most recent one. With that, I hope you can join us next month for Tax Planning 201, where I'm going to get a little more advanced than I did today on some ideas. But feel free to reach out in advance of that if you need questions answered. And I hope everyone on this call has a great rest of your day. Bye-bye.